Welcome, this is Drew Blazik, Logos and Markets. And in this video, we're going to talk about the equity schedule. We're going to complete the equity schedule and see what it plugs into and how does it affect the other financial statements. Again, in the notes below, make sure you visit the website Logos and Markets. You can download the Excel sheet that's driven by Sim, so it actually lights up green if you get it correct. And it's got a reset button where you can reset your work and do it over until you get it down. So let's get right to the equity schedule. Before we get to that part, I wanted to go over the grade. That just a quick review. The weighted grade is if it's done completed correctly, the actual equation. So it shows that this has a direct impact on financing. The overall grade is if it affects it indirectly, the other numbers. So you can go through this and see that the income statement is affected, but it is not directly affected on the from the equity schedule. So you can go through this whole grade here and see exactly where it is. And use this grade as you're plugging numbers in. If you made a mistake, you don't know where you made a mistake, use this to pinpoint where it's at. Okay, so we got the equity schedule at 0, so let's start there. Before we do that, let's go up to the balance sheet. And when you are creating the equity schedule, it's very important. Remember, the balance sheet is assets equals liabilities plus equity. That means this right here, if you go to the equity part, shareholders' equity on the balance sheet, these are the three line items that we must solve in the equity schedule. So go to the balance sheet and then you'll see exactly if they have preferred shares, common, and retained earnings. So let's start the equity schedule. So the first thing we're going to do, and I always go in order, if the balance sheet has preferred shares first, I will have that as the first on the equity schedule. So what we want to do is the corkscrew technique from the balance sheet. We're going to grab the last accounted year, recorded year, which is 2021. And what we want to do is bring in the ending balance, the amount of preferred shares that we have. So I'm just going to put the up arrow and go directly all the way to the balance sheet. And we're going to look up preferred shares, which is right there. This is going to be a total. Remember, the green cell means the number is correct, so it might not always light up until you finish the entire thing. And then the corkscrew technique means the previous ending balance becomes the beginning of the next year. So we're going to just bring that in, and then we want to know, do we have a new issuance or buyback of preferred shares? Well, that's going to be an assumption that we will make. I'm going to go to the assumption page, go down here to the preferred shares, and we are going to buy. If it's positive, that means we're issuing more. If it's negative, we're buying it back. And then all I do down here, I want to know the total. We're bringing in 0, we're adding 44. So what we're doing for the total is alt equals, and that's going to be the sum total, the ending balance. And that's important. Right away, you want to see that. There's two things that we're trying to do with preferred shares on the equity schedule is we want to know what the ending balance is, and that's for the balance sheet, so we could project the balance sheet later out. And then also we have to know what is the cost if we issue preferred shares, because we have to pay preferred dividends. So the first thing I'm going to do is I'm going to find out what is the dividend payout rate. I'm going to go to the assumptions, and we have it up here, preferred share yield, 10%. Now there's two ways of doing this. You could right away hit function F4, make it an absolute value, or you go right here and you want it equals, and I bring that in, and then I could drag it across. Whatever's quickest way. One thing you don't want to make a mistake is a lot of times people will drag it without putting the absolute value or connecting the next cell to it, and this will be blank, and you don't see it, and it's going to affect how much dividends you're paying out. So next what we want to do is we want to find out how much are we paying. Now, preferred dividends is not dependent on net income, which means if we lose money, we're still going to pay the dividends in our example. Now, by definition, preferred shares, we could make the decision not to, but typically we're going to pay it out no matter what. It's not depending on how much money we make. So I'm going to get the 10%, so it's less risky. And what we're going to do is we're going to multiply it times the beginning balance two methods. You could multiply it times the beginning, or you can multiply it times the average of the beginning and the end. Next, what all I want to do is drag that across, Control R, and fill to the right. Next, we want to do is the common shares. So same thing, the last recorded year, I'm going to go to the balance sheet, find out how many common shares outstanding there are. And that's going to be found in the equity part of the balance sheet. That's 120. And then I'm going to do the corkscrew technique. The ending balance of the previous year would become the beginning balance of the next projected year. And then what I want to do is I'm going to find out what is our assumption. Are we going to buy back stock or are we going to issue new stock? That's going to be in our assumptions page. I'm going to go down here. And in our example, we are, I forgot to hit equals. We're going to do 0. And then we want to know the ending. All equals. I'm going to sum those up. Control R, fill to the right. Next, what we want to do is find out the dividend payout rate. Then we have to find out net income. And then we have to figure out a certain function to determine, are there dividends to be paid? So this is very important with common dividends. It's a bit different than preferred. So let's find out what the payout rate is. That's under the assumptions. I'm going to go up here. It's going to be 20%. Now you get paid more at common. I want you to think about why. Is because common is more risky because it's dependent on net income. Therefore, they get a higher rate sometimes. Next, what we want to do is we want to plug in net income. So what I'm going to do is I'm going to hit equals. I'm going to go all the way up to the income statement. Now you have to be careful here. You have to pick the right net income. So we have net income, and then we have preferred dividends paid out, and then we got net income to common. A lot of students will mess this up, which will cause issues with your three-statement model. So common dividends are paid after preferred dividends are paid. So if the company made $100 net profit and we paid 100 preferred dividends, that means there's $0 for common. It's important to see. So you have to pick net income to common. We'll bring that in. All right, next what I want to do is I'm going to do a function, because if this number is negative, we're not going to pay anybody out, okay? If it is negative, we lose money for the year. Common dividends will not have a payout rate. So what I'm going to do is I'm going to do a max function, and the max function is going to be, we're going to do 20% times our net income. But I want you to think of what this means. Only if it's positive. So I'm doing a max function. I'm saying only I want the max, either the 20% times the net income or the number 0. And the reason I'm doing this, if this is negative, 0 will be greater. Therefore, we would have 0 common dividends paid out. If this is a positive number, that means the paid out dividend would be greater. That would be max greater than 0. So I want a positive number or 0 to show for common dividends, and that's going to correctly do it. And there you go. That's the mistake some people make when we do it, right? I didn't lock that dividend payout rate. I did it too quick. And if you don't catch it right away, you may have some issues with your financial model. So what you have to do is, I'm going to go across and then scroll to the right. Net income is not solved yet, so it's not going to be lit up green. However, we can go to the grade just to make sure we're doing it correctly. And as you can see, the grade, we are 100% on preferred. That means I did it correctly. And I'm 100% at common shares. We did it correctly. However, 84% of the common share numbers are correct. So when we look at this, 84% of it's correct, even because those numbers are not, but we did do it correct. Last, we're going to do retained earnings. This is the last part of the equity schedule. So again, I'm going to do the corkscrew technique. I need the last recorded balance. So it's the ending balance of the last previous year. I'm going to go to the balance sheet to grab that. I'm going to pull down retained earnings. We'll do the corkscrew technique. And then we have a bunch of numbers we're going to bring in. Next, what we want to do, here's another thing a lot of people make a mistake. They don't understand which net income we're going to bring in. I want you to think about what is retained earnings. You make a profit, you make net income, and you have two options you could do with that. You could pay the shareholders, or you could hold on to the money and reinvest it back into the company. So we have net income. I'm going to bring that in. And if you look underneath that, I'm subtracting out preferred and common. Okay. So we have net income. We'll subtract out preferred first, and then we're going to do common, and then we have our ending balance. This is important because since we have preferred and common, I'm going to take that first net income. If I wasn't subtracting out preferred dividends, I could take out the net income to common because I already subtracted out the preferred. So I don't want you just to memorize it. I want you to think it through. We're going to grab the net income. I'm going to go all the way to the income statement. I'm just going to scroll up. Well, all the way, I have net income, and then the net income to common already subtracted out the dividend, the preferred. So if I chose this one, that would be incorrect. That means we'd be subtracting out the preferred dividends twice. So what I want is this net income. Now, I don't want to confuse it because some people retain earnings may not have the preferred line item there. If they don't have that, I'm going to take the net income to common. That's important. So now what I'm going to do is I'm going to subtract out the preferred dividends because we got net income, and I'm bringing in 138.5 million retained earnings. So I'm going to hit a negative, and I'm going to go to the preferred dividend. It'll be right there. It has to be a negative because I'm going to sum those up, all the positives and negative. And then what I want is a negative common dividend. And then we can sum those up and then Control R. All right, so I'm going to go to the grade real quick. We are 100% completed with the equity schedule. However, we got about 79% of it with the correct numbers. And the reason why it's not 100%, we still have to plug it in the revolver. We still have to plug it in the equity part of the balance sheet, and we still have to plug it in the financing aspect of the cash flow statement. And then after that, it should be complete. Okay, so we're going to scroll up, and you kind of want to get this, you want to see in your head. First thing is the debt schedule. Why the debt schedule? Because for us to solve the revolver, if we have a shortfall of cash and we have to have short-term debt, well, I have to know how much operating cash flow, investing, mandatory debt repayment. Are we issuing new stock, common and preferred, or are we buying it back? And then I want to know, are we paying out dividends? So this is going to be a positive or a negative, depending if it's cash outflow or inflow. So what I'm going to do is make it easy. See the preferred dividends? I'm going to connect it to the retained earnings part. The reason is because preferred is on top of common. It's already in the negative. That would make it very quick and easy. Whereas let's go down, Control D, and highlight it, go across, Control R. And then the revolver is complete. Let's go to our grade. Let's look at the revolver real quick. So the debt is 100% complete, even though 31% of the cash is correct numbers and 85% of the revolver is correct numbers. But we did complete the revolver part of it. Next, we want to go to the balance sheet. So what we have to do, remember the schedule also does balances. We want to know the equity. We're projecting out how many preferred shares we have. This is going to be the ending balance in the projected year. So let's find the ending balance of preferred shares. So I'm going to go all the way to the equity. We're going to find that ending. Always remember that. The balance sheet's going to be the ending balance. Next, what we want to find is the ending balance of common shares. So the ending right there. And then the last is the ending balance of retained earnings. And then we're going to total those up. I'm going to hit all equals, sum those up, highlight it, make it go across, Control R. The balance sheet is still not balanced, but we're getting close. Go to the grade book. Let's go to the balance sheet. Although the numbers aren't 100% yet, because we still got to do the cash flow statement to make it correct. The balance sheet is completed, how we did it. So we're going to go up to the cash flow statement. This should be the last part that we're going to plug in. And what I'm going to do is we're doing the financing activities of the cash flow statement. We want to know, is it a cash change, a positive or negative? We already plugged in the preferred share buyback. That's from the assumptions. All we're doing here is the preferred dividend and the common dividend. Again, this is going to be a positive or negative depending if it's a cash outflow or inflow. Dividends are always a negative. They never come in as a positive. So what I'm going to do is I'm going to connect this directly to retained earnings because preferred is on top of common, and I can just connect it right there. It's already in the negative. I'm going to highlight that. You can hold that down, hit Control and R to the D. The only thing I wish I showed on here that you would have to plug in, I'm going to do that really quick, is this part here. This is our, have it locked, protected. This is the preferred dividend. We would have to plug this in for the income statement on your Excel sheet. I'll have it unlocked for you to make sure you practice to plug that in. That's going to be the projected dividend pay. That's going to be a positive number, income statement, even though it's a cost, it's going to cost us something. We always have it as a positive. And as you see, here's our net income, and we're going to subtract out that, and then we have the net income to common. Let's go to the grade book just to make sure we're 100% complete. Our overall grade is 100%. Our weighted grade is 100%. Our balance sheet is balanced and it's 100% completed. Thank you for watching. And again, go to Logos and Markets website if you want the Excel file, and you get to practice it until you get it down. Thank you.